Hello and welcome to the VRIC Media channel, where our mission is to educate you on how to make money in the resource sector. I'm your host, Ted Butler, and today I'm very glad to be joined by Incrementum Fund Manager and In Gold We Trust Report founder, Ronnie Stoeferle. For context, Ronnie was kind enough to allow me to contribute to the In Gold We Trust Report for the last couple of years, so I'm really grateful today to be speaking with him. Ronnie, thanks for coming on the show.
Thanks for having me, Ted.
Okay, so I guess we start with the big picture. In Gold We Trust Report came out back in May after much hard work. I think it'd be a good start if you could, identify the meaning behind the main leitmotif this year, which was the new Gold Playbook. What made you settle on this title in the end, and what are the main overarching themes encompassed by it?
Yeah, well, Ted, first of all, it's been a pleasure working with you. When you actually messaged me, I thought, okay, Ted Butler, I know this gentleman. Actually, the other Ted Butler, he died a couple of weeks ago. So
yeah.
Rest in peace.
Very sad, yeah.
But you wrote like one of the most brilliant letters of motivation. It was basically a rant about our monetary system and why gold is crucial. So I said, okay, I like this young guy. So very happy to seeing you succeeding and also getting like more and more of a profile in the precious metal space, and I think it's well deserved. So
massively appreciate that.
Thank you very much. Well, the thing is, every year we try to come up with a leitmotif, with like one title that really explains what's going on in the gold world. And last year we had the leitmotif of a showdown, which played out pretty well. And this year we've got the new Gold Playbook, because we sat together with the whole team at the beginning of the year and said, real interest rates are rising big time. So nominal rates are rising and inflation numbers are coming down, which should be, headwinds for the price of gold. But still, gold is trading close to new all-time highs. And then we said, okay, usually we should see some ETF inflows, but we're still seeing outflows. So the Western financial investor couldn't care less about gold. So something is actually happening in the gold market. And we said, okay, well, it seems that there's really a new playbook that we have to deal with and to work with. So this was basically the idea of this year's report. And we said, okay, so it seems that real interest rates in the US are no longer the ultimate factor for the gold price. We said that central banks, and especially emerging market central banks, are actually increasingly influencing the gold price. So, let's say the marginal buyer, the marginal gold buyer, has moved from the Western world to emerging markets. We said that inflation is actually gonna be sticky, and we expect much more inflation volatility. So we basically described the 10 key points of this new Gold Playbook in this year's report, and I think so far it's playing out pretty well.
Indeed, yeah, and I guess one of the things that you talked about in terms of how to navigate this new playbook was your kind of re-engineered version of the 60-40 portfolio. And in my understanding, this involves an allocation of 45% stocks, 15% bonds, 15% safe haven gold, 10% performance gold, 10% commodities, and 5% Bitcoin. So, of course, this is a drastic change from the 40% bonds exposure that traditional investors have been accustomed to over the years. But I guess, to play devil's advocate, why should investors abandon the tradition of bond-dominated portfolios of the past and embrace this new Gold Playbook, in your view?
Well, the thing is, I think, there's very, very few investors, active investors around that actually worked in an environment of high inflation, of volatile inflation, like in 1970s. So during this so-called Great Moderation, where inflation numbers were coming down, bond prices were going up, obviously. Basically, for 4 decades, I think we all got really used to the fact that inflation isn't a crucial driver for the construction of a portfolio. Actually, while I'm often mentioning that, but because I think it's really important. When I delivered 2 keynotes in Turkey, in Istanbul, investors there, they asked really the most interesting, thought-provoking, and the most educated questions, because for them, obviously, inflation has always been a concern, and inflation was actually, or let's say to understand inflation and to forecast inflation, for them has always been crucial for portfolio construction. And from our point of view, we will be going back to that environment where inflation plays a much more important role for portfolio construction. So actually, we came up with this a new version of the 60/40 portfolio, because actually we had in the 1970s, for example, Harry Brown. He was a great sound money guy, and he advocated the so-called permanent portfolio, which was 25% equities, 25% bonds, 25% cash, and then 25% gold. And then we had this great moderation that I talked about. And of course, due to back testing and fitting a portfolio basically to prior performance numbers, everybody started investing into some sort of a 60/40 portfolio. But from my point of view, this allocation should not be set in stone. So it's 60. Our interpretation of the 60/40 portfolio still says, okay, stocks 45% instead of 60%. But I think the major change is that we're seeing only 15% bonds instead of 40%. Yeah. And we substitute that for what we call safe haven gold, which is physical gold stored in a safe jurisdiction, probably outside of the banking system. And this is something where you don't look at the price every day. This is really like an insurance. But then we also like so-called performance gold, which could be silver, which could be mining stocks. This is a definitely much more active part of the portfolio. Then we would see 10% commodities and 5% Bitcoin as our kind of rule of thumb for portfolio allocation for the next, let's say, 10, 15 years, something like that.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galiano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
And just touching on the commodities part of that, within that, I know at Incrementum you have a uranium fund. Just tell me about your thoughts on uranium and maybe also copper as well. Is that something you're taking a look at? I know a lot of key mining stakeholders are taking an interest right now.
Yeah, I mean, we one of our partners, Christian Scherer, he's very, very successfully managing the uranium fund. I can tell you, there was a big change in sentiment over here in Europe, especially when it comes to uranium. Because like 3 years ago, if you would have said, we are investing in uranium, people would have said, okay, yeah, so you're trying to build a nuclear bomb, or what's going on with you? And now, even Greta Thunberg, she's admitting to the fact that we actually will need nuclear power for the transition. And as you know, we wrote in the silver chapter that it's been quite similar with the supply demand case in the uranium space that. Yes. That was crystal clear for a couple of years, actually, yeah. But we didn't really see any momentum. We didn't see any catalyst. and then it happened pretty quickly. And I think for the silver space, it's pretty. For me, it's pretty obvious just with the growth from the solar industry. But it often takes time, and you know, those forces add up, and at some point, you know, they just start picking up momentum. However, I think in the commodity space, you know, last year was a tough one with interest rates rising, you know, Chinese demand being pretty weak, European Europe being basically in a recession. So commodity prices took a breather after 2 brilliant years. This year is a tough one as well. I have to say we're seeing very, very strong performance numbers in the precious metal space, but they're also, especially in the gold space, while silver continues to underperform. We've seen some moves in the copper space, we've seen some moves in the energy space, but still it seems that we're not really there yet. And this is basically telling me that the market is showing us that a recession, that we are already in a recession, or that at least, you know, we're starting to discount, not a soft landing, but rather a hard landing. I think this is really the market picture that developed over the last couple of weeks with, the yield curve uninversion, then, ISM coming in pretty weak. The SAM rule, for example. So I think that we are now kind of realizing, well, everybody's still, enjoying the summer, but I think at the latest in September, the market will start realizing, okay, we should perhaps talk a little bit more about the recession risks and, not talk about Goldilocks, soft landing, no landing anymore.
Well, this was one of the things I noticed on your Twitter as well, that you noted that a JP Morgan chart that shows the majority of US markets, whether it's credit, equities or whatever, are not actually pricing in a recession.
Yes.
And yet, when we look at the hard data, you mentioned the SAM indicator being triggered in recent weeks, that would suggest that a recession is likely on the horizon. So I guess my question is, do you think that, you already said it, but do you think a recession is already a done deal? And do you think a September Fed rate cut would even make any difference from preventing one?
No, I don't think it's going to make any difference. I mean, how many recessions did the Federal Reserve actually call, and when haven't they been behind the curve? So yes. I would kind of doubt that. The thing is, if you think we will have a soft landing, then I think you should probably continue buying equities. Yeah. But if you are in the recession camp, like I am for quite a while actually, and we've been wrong, then I suspect that the Fed will be chasing interest rates lower. And I think at the time being, a soft landing is fully priced in. So you basically don't make a lot of it out of it if that really materializes. On the other hand, I think a recession is still very much of a contrarian take, and I think the trade currently is it's basically the mirror image of the situation of a year and a half ago, when everybody thought the recession was for sure gonna happen. So that's a pretty interesting setup that I'm seeing. And as I've said, some of the most reliable recession indicators are basically confirming that. And if we have a look at commodity prices, if we have a look at the gold silver ratio, for example, it's telling me that recessionary risks are rising. I had a conversation with a great friend of mine who's a very, very successful bond trader at a large institutional house, and he said, probably the most contrarian view that he has articulated with his colleagues is that rates will go to zero again. They were ridiculing him, because everybody says, okay, rates will fall and the Fed has everything under control and we'll do like 3, 4, 5 rate cuts. Yeah, but then we'll settle at somewhere like 3.50 or 4, whatever. But nobody is seeing actually that the Fed will go to zero again. It's not my base case, but can we rule it out if there's some panic in financial markets, if we're hitting a hard landing? No, definitely not. So this is I think this is really a question that we should ask ourselves. What's going to happen in financial markets if we go to zero interest rates again?
And perhaps that's when the conventional playbook would come back in for gold and silver as well. One of the things I did want to ask you, Ronnie, as well, staying with the US economy, is this theme of de-dollarization. It's obviously been a hugely contentious topic over the last few years. On the one hand, you've got this argument, people saying the US dollar will remain the king. As you pointed out in the In Gold We Trust Report YouTube channel in that really informative video, the fact that the US dollar is still used in approximately 88% of all global FX transactions certainly provides strength to that argument. But then on the other hand, you've got the weaponization of the US dollar, as we saw in 2022 with the freezing of the Russian assets, which has caused the US dollar's share of global foreign exchange reserves to fall from 70% in 1999 to 58% in 2023, as you pointed out. So my question to you is, as we're seeing the BRICS, China, Saudi Arabia team up and trade in currencies that are not the US dollar, how long do you think it will be before the US dollar loses its exorbitant privilege?
I think it's going to take longer than we would expect, and then it's going to happen much more quickly. I'm currently rereading a book called The Mandibles, which is I don't know if you've read it. It's fantastic. Yeah, it's about some sort of a great American family, kind of a dynasty in New York. And actually, the author Lionel Shriver, she's describing how inflation and changes in the international monetary regime are actually affecting this family. And it's a brilliant read, and she says in 2000, and this book was written many years ago. Jim Rickards he once recommended it to me, and I just reread it. And they say in 2024 actually there's the so-called Stone Age, where the internet breaks down and there's like civil unrest and everything. And then in 2028. The president has like a big speech where he says he has to cancel all U.S. debt, and he's confiscating physical gold, especially after this enormous surge in the gold price, due to the fact that the BRICS countries are actually introducing a new currency. So I thought it was really fascinating because those things are kind of playing out. And Ted, as writing and working on the In Gold We Trust report is like it's a huge undertaking, and it's really hard work. But I love it, and I still very much enjoy it after 18 years. And we did a trip to the library of the OPEC in Vienna, because we actually analyzed all the communication that came out from the OPEC after the United States under Richard Nixon temporarily decoupled the US dollar from gold, and we found this this document that was issued after, I think it was a special meeting of OPEC in October 1971, and where they said actually, due to the changes in the international monetary system, we have to reconsider the pricing of oil, and that obviously was the start of the first oil crisis and the first inflation wave. Now, if we translate that to the current setup, there was a very, very interesting quote from Alexei Miller, the CEO of Gazprom, where he said in June 2022, we don't play by the rules that we didn't create. So, imagine if like the BRICS plus countries that are huge producers and exporters in the commodity space, not only oil and natural gas, but also agricultural commodities, copper, nickel, rare earth, and so on. If they would actually do like something similar like the OPEC did in the 1970s, I mean, that obviously could trigger another wave of inflation and probably quite some economic turbulence and political and also probably social unrest. But if they say, they don't want to play by the rules that we didn't create, this is something to be taken serious. And we've seen so much momentum in the BRICS and the BRICS Plus, with the meeting coming up in October in Russia. Well, if you have a look at the agenda, they will talk about monetary things. There is some rumors about this unit currency that is being proposed. So clearly, it's game time. But I think the United States will definitely not give up this privilege very, very quickly and easily.
Yeah, it's one of those things that I think will be a long process. But I guess the BRICS as well, they're stronger together, but they also have their own individual domestic problems. And I did want to ask you about China specifically. I think you pointed out on Twitter again that Xi Jinping seems to be pivoting from this export-driven model to one that's more reliant on domestic consumption as part of this fortress economy that he's coining. So do you think this strategy will be enough to prevent a deflationary spiral in China? Obviously, they're not in a deflation yet, but they have been back in January, and there's still very low inflation. And do you think China will muddle through?
I think that the whole world is underestimating what China actually does. Unfortunately, I haven't been in China in a while. A friend of mine, he just came back and he said all the technological development going on there, it's like, if you go there, it's like going to the future. And if you're coming back to Europe, you feel like, okay, are we like in the 1960s or so first of all, this year is the year of the dragon. So it means evolution, it means progress, it means prosperity. So it's an important year for China. I would say that many people were a little bit. I think expectations were different before the third plenum. Basically, they said, okay, there will not be any big bazooka. There will not be any, big monetary or fiscal stimulus. They have some sort of a, let's say, an Austrian approach with trying to deflate and to shrink the let companies fail as well. So that they're not bailing out every bank, every real estate developer, which I find is pretty interesting because it's a much more capitalist approach than we have in the Western world. And then on the other hand, everybody who was surprised to see no bazooka from the fiscal side probably hasn't been listening to what Xi Jinping has been saying for the last several years. He said the focus is on science and technology, and this was already this focus was already set way before the plenum was held. So China really wants to become a science and a technology superpower by the year 2035, and I think they're really on the right path. So their R&D spending as a share of GDP is now, I think, 2.8%, and has basically reached the level of most OECD countries. So the big question that I have as an let's say an Austrian. Is the question if technological disruption can really be organized from the top. So I'm not so sure about it, but what I'm sure about is that China is really going all in science and technology, and I think that we're all underestimating China, and therefore I think that also the Chinese stock market at these prices, there's tremendous value to be found.
Very interesting. Very interesting. One of the things I noticed about China in the In Gold We Trust report, of course, was the fascination amongst the younger generation with gold, with these gold beans. it's a theme. This sort of fascination with gold hasn't really translated to the Western culture as much. And you call it the image problem of gold in the report. So, why do you think this is the case? Why is that distinction different? And, why do you think professional and retail investors in the West view gold with skepticism still?
First of all, I have to say that was really important for me to write about this image problem of gold in the West, because there's like two important narratives when I talk to people in the Western world. And the first one is gold is only for right-wing lunatics, for Nazis, for Trump supporters, for preppers, whatever. And the second one is that gold is dirty and it's useless, and you don't need it, while cobalt or lithium are super important, and we need them for the green transition, whatever. And I think it's important for us in the industry to address those concerns, those things, and this is what we tried in this chapter. So I think, first of all, there's a big divergence between, the view of gold in the Western world versus emerging markets. So when I talk to people from India, from Turkey, from China, obviously, gold for them is being seen as money, obviously, as monetary insurance, as something very, very positive. While in the Western world, many people feel that, especially if you do it for the first time, if you buy physical gold, it's actually something, something kind of mysterious, something that you have to be ashamed of. Yeah. From my point of view, it's an active decision to leave the fiat money system. But many people feel kind of threatened, they've got a bad feeling when they're buying physical gold for the first time. So I think, this narrative, what Ben Hunt calls a narrative machine, and how, strategic communication actually shapes perceptions. We've seen it in Bitcoin, for example. We've seen it with, Bitcoin is only being used for tax cheats, for criminals and so on, and then Bitcoin uses so much energy, and it's used for organized crime. It's unpatriotic. It's only for Putin fanboys. We know how that works, actually, and I think it's also a means of financial repression. We should get in the Western world, for example, in Germany, if you don't want to show your ID when you're buying physical gold, you cannot buy an ounce of gold anymore, because the limit is 2,000 euros, and it's falling in basically every jurisdiction. So I think it's important to address, first of all, that gold shouldn't have this negative image, and then on the second hand, I think it's also important that most of the miners, especially the ones that are listed on the stock market, I think they're doing a tremendous job when it comes to ESG and building critical infrastructure, building hospitals, schools, well-paying jobs, and so on. So I think those things are pretty important to address, and I think it's also something everybody in this industry has to do to some degree to really change this negative perception that gold has.
It was great points. And actually that's the thing, we're pushing against the tide. One of the things I watched a couple of years ago, actually, was an ABC documentary about gold, Australian broadcasting company, I believe. And they were showing gold with these criminals, just, associating them with these like big muscular tattooed guys with gold chains coming into the Perth Mint and buying gold. The UK as well, the media, I think they called it an abhorrent tax evasion. I read an article a couple of years ago. So that's the challenge, isn't it? We're pushing back. But I guess one of the ways we can push back against that challenge is by providing optimism, reasons to be optimistic about the future of the gold price itself.
Yes.
And on Twitter, you noted that gold is still not even close to its inflation-adjusted highs. In the report, you make the strong case for the gold price reaching $4,800 by the end of this decade. And more recently, in the August edition of your monthly gold compass, which I definitely recommend our viewers check out, you calculate there's a 2.4% probability that the price of gold will be more than $12,500 by 2030. Now, obviously, that's the top end, but it's still food for thought. So I guess maybe if you could provide some justification for those numbers and maybe some technical analysis as well, if you can.
Yeah, Ted, sorry. We've got, I've sent you a couple of charts before, and I think it's great to discuss them. So, for example, the one on slide 33, which shows our gold price model. We published that in the Gold We Trust report 2020, where we laid out our big framework for the decade ahead, and we said it's going to be an inflationary decade. Now, back in the days, talking about inflation in 2020, it felt kind of strange, but we said, okay, there are some really strong drivers for us to think that inflation will become more of a concern compared to the great moderation that we talked about. So we came up with this gold price model that has basically it's a very simple model, and it includes, first of all, the future development of the money supply, where we say, okay, what's M2 growth gonna be in the next couple of years, and we've got a base case which would be 3.9%, which was the lowest rate that we've seen since the 1970s. Then 9.7% M2 growth. We say, okay, this has a 15% probability, and then the average M2 growth since over the last couple of decades, which was 6.3%. And then we also calculate an implicit gold coverage ratio. And then we come up with this distribution probability, and you can read it up in Gold We Trust report 2020. And based on these probabilities, we said that the probability weighted peak at the end of this decade would be $4,800. Now, back then, everybody said, you're out of your minds, you're crazy, you're I don't know, potheads, whatever. Now people say, oh yeah, it can happen, but still, I did a couple of keynotes recently with I would say more of a generalist audience, so not like a diehard gold bug audience, but really, generalist investors. And when I say that gold trading at $2,400, that it's dirt cheap, they just shook their heads and they think I'm crazy. So this is, from my point of view, a good sign, because we don't see this irrational exuberance in the Western world, at least. Now, if we do a little comparison, Ted, that's on slide 3 and slide 4. We shouldn't forget in 2008, I remember it really well, when we made $1,000 for the very first time. That was, I think, in March 2008, when Bear Stearns broke down. So everybody was excited about, gold trading above $1,000 for the first time. Then it got quite dicey, and the great financial crisis with Lehman Brothers and everything happened. People were desperate for liquidity. They sold gold. Obviously, the Federal Reserve did what they do best. So they lowered interest rates and they started printing. They introduced the first round of QE, but still it took us a couple of months. And I think it was like from March 2008 until September 2009 for really, on a sustained basis, break above the $1,000. level. And this is obviously a psychological level that is really important for market participants. And then actually within 18 months, the price of gold almost doubled. So we went up 90%. If we move to slide 4, we shouldn't forget that we've been consolidating around the $2,000 level for almost 4 years. And as you know, the longer the base, the higher the space. So now we finally broke out of this consolidation pattern. So can the price of gold actually double in the next couple of quarters? From my point of view, definitely. But I would say for most mainstream investors in the Western world, and they are actually not invested at all. Yeah, you've probably seen those stats by the Bank of America about the average gold allocation of investment advisors, which is 70% of all investment advisors hold less than 1% gold. So if there's some move from Western investors as well, I think we can easily hit those levels. And I'm not talking about a big revaluation or let's say a reorganization of our monetary system. So as stupid as it may sound, Ted, from my point of view, relative to other asset classes, relative to its history, relative to historical bull market analogies, relative to debt, obviously, yeah. I think that gold is still dirt cheap.
Brilliant. Yeah, still undervalued. Okay, well, one of the things I wanted to touch on before we finish was of course Bitcoin. Now, I've made my points clear about this. I'm not against Bitcoin. I think it's worth a speculation, but I think you're certainly more bullish on it than I am. Obviously, we've had the conference in Nashville a couple of weeks ago where Donald Trump made a speech, compared Bitcoin to the steel industry of 100 years ago. He said Bitcoin will probably overtake gold one day in terms of market cap. So I guess my question to you is, what makes you bullish on Bitcoin to the extent that you and Mark are? And also on the other side of things, what risks do you think that the maxis are blindsided to at present?
Yeah, well, Ted, I mean, I wouldn't give too much about what politicians are saying before elections. I don't think that Donald Trump. I mean, his hair is orange, yeah. So perhaps he was orange pilled. But I wouldn't overestimate that actually. Yeah.
Okay.
For me, first of all, I think that. We know that in the gold and the silver world, there's lots of emotion. I don't like the term gold bug because I don't think it's something positive. I think, if you've got a proper understanding of monetary history, then of course, you're very likely to understand and to appreciate gold. But gold is not a religion. Gold is something fascinating, something that I truly love. But at some point, there will be a time when you should probably be selling some gold and buy probably bonds, equities, real estate with that capital. We're not there yet, obviously. There will always be. I think you should always own gold, as we call it, the safe haven gold. But this performance gold portion of your portfolio, I think at some point it will be time to lower that allocation. However, the discussion that I'm seeing in the Bitcoin world very much reminds me of this diehard gold bug attitude, yeah, with the Bitcoin maxis that are ridiculing, the gold bugs and from my point of view, first of all, it's all about the stock to flow ratio. Bitcoin has now overtaken gold in terms of the stock to flow ratio. I think that whoever Satoshi Nakamoto was, we have to say he must have been brilliant. He clearly understood gold. He clearly understood monetary history. He clearly understood the flaws of our monetary system, and he clearly understood Austrian economics. So, gold versus Bitcoin. Gold's market cap is, what is it, approximately 15 trillion at the moment. Bitcoin is a little bit more than 1 trillion, obviously highly volatile. But as I've said, and this is a little bit what Mises basically said, that for an asset to remain money, the public perception must not anticipate its rapid and unstoppable increase in quantity. And in this year's In Gold We Trust report, I think we had it was a very, very simple explanation, but many people told us, well, this is actually, it's pretty brilliant, and I have to say I wrote it first in one of Lynn Alden's newsletters that are always worth reading, and she said, okay, coming back to this future supply topic, she said, okay, for the United States in the next 10 years, and those are official CBO numbers, so Congressional Budget Office, they expect deficits between 1.5 and 2.5 trillion. Even under the assumption that there's not going to be a recession in the United States and not going to be a financial crisis. So that's pretty optimistic, I would say, for the next 10 years. So there will be, let's say, 20 trillion of additional supply of US government bonds. Now, US government debt is roughly 1/3 of total US government debt. So it's going to be like 60 trillion, or let's say between 50 to 60 trillion of future government debt. Now, of course, I mean, that's going to depend on politics and everything, but I think the trend is pretty clear. Now, for gold, we know the historic growth rates of gold. We know that one of the virtues of gold is that actually the inflation rate, the money supply growth, is very, very low and very stable. So let's say at current gold prices, we will see 2.5 trillion of future gold coming into the market, at current production rates and current prices. Now, for Bitcoin, due to the code, we know that there will be 1 million Bitcoins mined in the next 10 years, and that there's going to be 2.5 halving cycles. So we already know how much future Bitcoin will come into the market. So that's of course that's only the future flow and not the stock. But I think this, in a world where inflation is becoming a concern, where fiscal debt is getting out of control, I think you just want to hold assets where you know that there's not a rapid increase in quantity. So I think there's a strong case to be made for both very hard assets. Although I know that people will, from the gold camp, but also from the Bitcoin camp, will give me lots of hate. But as an asset manager, running the numbers and the risk profiles, there's a good reason why we introduced two funds that actually combine gold and Bitcoin. Yes. And the life track record is phenomenal. And we've got an investment process that uses the enormous volatility of Bitcoin. So we're harvesting the volatility by the options market. We've got a rebalancing strategy where once one asset goes too high, then we basically cut it down and reallocate. So I think it's a prudent approach, and the fact that we're getting so much criticism, it actually confirms my view that this is something that's actually pretty right to do.
Yeah, it's a very nice diplomatic way to end. I think, Ronnie, I really appreciate you coming on. Is there anything you want to add before we go in terms of your links, places we can find you, and your different ventures that you're doing at the moment?
Yeah, you can find me on the beaches of Sicily for the next 2 weeks. So
Lovely.
I'm finally going on vacation. Yeah, I mean, then I'll be hitting the conferences in Beaver Creek and Colorado Springs. Obviously, we'll do a keynote at the Denver Gold Show and a fireside talk with John Hathaway at Precious Metal Summit. You can download all our In Gold We Trust reports on our webpage, ingoldwetrust.report. Obviously, there's great chapters about silver also included, written by Mr. Ted Butler.
Thank you.
So, and then I'm also pretty active on Twitter. I'm putting out especially macro charts, but then also some fun stuff and stuff about books, but also sports. So Ron Stoeferle, that's my handle on Twitter.
Perfect. We'll put all that in the description. Ronnie, thanks for coming on, and we'll see you later, guys.
Thank you very much, Ted. Take care, my friend. All the best. Bye-bye.